There's Mr. Michael Brown. Thank God for that. He can do all the talking today. Invite co-host. Oh, has he just dropped off? Oh, he's back again. Mr. Michael Brown. Send invite. I'm hoping the invite has been sent through the interweb. Morning, Yuresh. Mr. Brown, have you got the invite?
Good morning, Ryan. Good morning, everyone.
Oh, good morning. One sec, let me do the legals. Nothing discussed on this space session constitute trading or investment advice. Any form of no, that's wrong.
Oh, Jesus Christ.
Oh, I'm very, very hungover. Nothing discussed on this space session constitutes trading or investment advice or infers any kind of endorsement by PRQ Global Limited, trading as PRQ or PRQ Suite, or indeed the hosts, which, as you know by now, is Mr. Michael Brown and myself, are very, very, very hungover. Oh, actually, no, that's a lie. I'm still drunk. What's my name? Ryan.
See, this is what happens when you lose my steadying, sensible influence after I went home at about 8:30.
Yes, yeah. I did not go home at 8:30.
Dear me.
Also, I'm not going to lie. Zach's going to listen. He's going to be very annoyed because I've not even looked at the notes he sent me. So there's going to be nothing from me today. Over to you.
Oh, dearie me. Well, good morning, Ryan. Good morning, everyone. Oh, Yuresh, good morning from Dubai. Of course, our last space of the year. Let's have a quick look back at yesterday then. There were plenty of policy decisions for markets to get their teeth into yesterday. Firstly, we obviously heard from the Riksbank in Sweden, which we did cover off during the show yesterday. But just to recap, they did indeed deliver a 25 basis point rate cut, taking rates back to 2.5%, while also repeating their prior guidance that they believe rates are likely to be cut in the first half of next year. We also heard from the Norges Bank yesterday, who held rates steady at 4.5% as expected, and guided once more that rates will likely be cut in March of next year. Again, very much in keeping with both market expectations and also with what we had heard previously from policymakers in Norway. And last but by no means least, we had a policy decision from the Bank of England yesterday. As expected, the old lady holding bank rates steady at 4.75%, but the vote split was considerably tighter than market participants had foreseen. We had a 6-3 vote in favour of bank rate holding steady, with those three dissenters favouring an immediate 25 basis point rate cut. And those dissenters were, of course, Uber Dovish external policy member Dingra, along with external member Alan Taylor, and surprisingly, Deputy Governor Dave Ramsden. And I say surprisingly because it is very unusual to see one of the internal members of the MPC dissenting against the policy action. So I think that could just be taken as a signal that the BOE are indeed going to deliver their next cut in February. The guidance accompanying the bank's policy decision was very much in line with expectations, reiterating that a gradual approach to rate cuts remains appropriate and that policymakers are still in a data-dependent meeting-by-meeting mindset with a desire to keep policy, and I quote here, restrictive for sufficiently long in order to reduce the risks of inflation persistence. One line that was interesting from the BOE, though, and this was actually buried deep in the minutes of the decision. And I quote here, and this is that bank staff now expect zero GDP growth in the fourth quarter of 2024, weaker than the 0.3% growth that had been incorporated into the November monetary policy report. So clearly, the bank believing that downside risks to the economy are mounting. And of course, that is reinforced by the most recent PMI surveys and some other sentiment data that we've had in recent weeks. Speaking of data, we had a bit of a data deluge out of the United States yesterday. 30 third quarter GDP revised up to 3.1% on the final reading compared to the 2.8% first and second estimates. That now represents the fastest pace of GDP growth since the fourth quarter of 2023. We also had the weekly jobless claims data, initial claims rising by 220,000 in the week to the 14th of December, about 20k below the previous print and also below the consensus estimate. And of course, that initial claims print does pertain to the December non-farm payrolls survey week. In terms of other bits and bobs from yesterday, we had a few ECB speakers, although they were just reiterating that rates are on a downward path and that the pace of future cuts will depend on very much how incoming data evolves and also the latest ECB projections. In the tech space, this actually broke yesterday morning, but I forgot to cover it, so I may as well cover it now. That is that Indonesia, they have approved Apple's plans to invest $1 billion in the country, which is just one worth watching there. Of course, Apple continuing to diversify away from China. And we also had a few headlines from President Trump over the last 12 hours or so. The first is, according to NBC, Trump is in favor of entirely abolishing the debt ceiling in the United States. This is something that I am fully in favor of, given that it's not a ceiling because it just gets lifted every time.
You know
may
what?
as well
I'm
just
sure
get
we
rid of it
said this,
altogether.
like, pretty much even possibly one of the first spaces that we did. It's like, it's not a ceiling, it's a target.
Yeah, I think we might have done, actually. You know, it is ridiculous just the way that it gets raised every time. So Trump is potentially talking about that. Of course, this comes as the US government could potentially go into a government shutdown later on today if Congress can't get a funding bill passed. We also heard from Trump this morning. He was ranting away on his social network, and I quote here, "I've told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Otherwise, it is tariffs all the way." And just for good measure, he's put tariffs in all capital letters as well. So Trump clearly taking a relatively hawkish stance there, as we would expect. Just lastly, in terms of market moves, it was a pretty flat day in the equity space yesterday, although we have seen futures taking a little bit of a lurch lower since the European Open. The dollar also softening just a touch, coming away from yesterday's 108.50 highs. And it was an interesting day in the Treasury market yesterday. We saw gains at the front end of the curve, with two-year yields rallying by around 6 or 7 basis points on the day, and this morning trading south of 4.3%, but continued selling pressure coming in at the long end with benchmark 10-year yields getting agonizingly close to 4.6% yesterday. So just worth watching some moves there, but of course do bear in mind that liquidity and volumes are very, very thin indeed, and only going to get worse as we move into next week. I would ask if you've got anything to say, Ryan.
No, I'm not. I'm so going to apologise to Zach because I've not even read his message because I honestly, I've had to close my eyes. I'm not in a very, it was the PIQ Christmas beers last night. I'm not very well this morning. So back to you in the studio. You were out with us. You left at 8:30. I got home at about 2:00.
Oh, dearie me. At least you got
and
home.
I wasn't sober when I left you.
Oh, God. One thing on Zach's note, actually, a little point of improvement for the young man for next year. Use less acronyms. What's this? TGIF, HAGW, COYG, LOL, LMFAO. May as well be a foreign language, and if you can spell that, I'd be amazed. Right, moving on to today then. We've already had the latest retail sales figures out of the UK this morning. Headline sales disappointing compared to market expectations, rising by just 0.2% on the month in November. That is compared to the anticipated 0.5% increase, but it is marginally better than the 0.7% decline in sales that we saw in October. October. Excluding fuel, retail sales rose by 0.3%, again below expectations. One thing that is just worth bearing in mind on that data, though, is that the ONS, their survey period ended on the 23rd of November. So the sales metric likely doesn't take into account a lot of the Black Friday and Cyber Monday discounting that went on, which may explain away some of that downside surprise. In terms of the rest of the day then, the European session was relatively quiet in terms of major releases. We do have some notable prints due from across the pond, though, this afternoon. At 1:30, we have the latest core PCE figures out of the United States. Of course, this is the Fed's preferred gauge of inflation and what they use to measure progress against achieving their 2% inflation aim. I don't think this PCE print is going to be a huge market mover, though, because Chair Powell at the post-meeting press conference on Wednesday effectively told us what the numbers are going to be. And he said that headline PCE will likely be at 2.5% year on year in November, and the core PCE metric at 2.9%. Of course, also bear in mind that the Fed are focused still on labour market developments as well, and I think that still has a little bit of precedence in determining future rate moves. Also at 1:30 this afternoon, we have the latest retail sales print out of Canada. This is October data, so it is very stale, but nonetheless sales seem rising by 0.7% compared to the 0.4% increase that we saw previously. And then at 3, we have the final read on consumer sentiment out of the University of Michigan, and that figure expected at 74.2 compared to the preliminary reading of 74 exactly. Of course, do also just bear in mind today that the FOMC's blackout period does come to an end. We are scheduled to hear from Daly, Williams and Hammack as the day progresses. And of course, Hammack dissented against a 25 basis point cut at Wednesday's meeting. So her remarks will be interesting, but she doesn't vote next year, so don't place too much weight on them. And do, of course, just bear in mind that we do tend to hear from various other Fed officials popping up on the media before the weekend when that blackout period comes to a close. That is then pretty much it from me for today and for this year. So thank you very much to Ryan, firstly, for putting up with me every morning, and to everyone who's listened over the last 6 months or so. And a very, very Merry Christmas and a Happy New Year.
Mr. Michael Brown, as I've told you many, many times, I am internally grateful for you to be doing these shows with me in the morning, especially on days like today when I cannot see and I'm struggling not to throw up.
I was going to say it's an absolute pleasure, but maybe not on a day like today.
No, it really isn't. If it wasn't the final show of the year, you would have been getting a text message about it. We ain't doing today's, mate. I can't do it.
Technical issues.
Yeah, this is exactly it. But no, seriously, my dear friend, you know how much I appreciate all of this. So thank you so much. 2025 hopefully will be an amazing year for us both. And for our listeners, thank you so much for tuning in for the last month or so, or a couple of months that we've been doing them. And more to come in 2025. Have a great Christmas and a Happy New Year. Try and stay out of trouble. Don't do anything I wouldn't do. Well, I don't know what that is, but yeah.
That's a very low bar you're setting there, mate.
Yeah, very, very low bar. I'm going to go order a KFC to be delivered to my bed, and we will see you all later on.
We will see you in January. Bye-bye.
Bye-bye.